Live without a net, TG Tuesday, Tony Greer. I'm Ash Bennington. Welcome to the Real Vision Daily Briefing. Welcome, Tony.
Slash Bennington, what's happening, baby? How you doing?
I don't know, man. There doesn't seem to be a whole lot going on. Things feel a little quiet, a little sleepy. I don't know, a little dull. Is that fair to say?
I was going to say we still have a lot to discuss, although it seems to be coming at us at a reasonable pace for a change. You know what I mean?
Yeah.
Like the news fire hose is almost digestible to start off the week.
That is indeed a change of pace. Tony, here we are, June 1. I know that you very often look at things across multiple time horizons. You do a lot of analysis end of month. Anything stand out at you about May?
Yeah, Ash, there's always great information in the tea leaves, looking at every close for me, from the dailies to the weeklies to the monthlies. But when you become a trend follower, and you let the markets teach you what's happening, you sit down at the end of every month with a big smile on your face and a cold beer and look at what the fallout was. So I kind of start off with my harbinger, noticing that, the dollar fell 1.5% in May, which is kind of secular trend revealing itself. We have
Tony, which metric are you looking at? Is that DXY?
Yeah, I keep it to DXY for our purposes, Ash. We want to focus on the commodity currencies. Really, that's the sort of drill down if you need to hear it. What I look at beyond that is I kind of look at the Aussie dollar, I look at the Chinese yuan, I look at the euro, and I kind of just see how they're playing out against each other for the sort of speedometer on my commodity trade, if that's fair. So the dollar weakness we've been expecting, I think it's going to be pervasive. So I think this is a secular trend that continues to reveal itself off 1.5% in May. Obviously, the big splash in May was Bitcoin, right, coming down from 56K to about 36K by the time it was all said and done. We got, I think, the best quote in the Bitcoin markets since Bitcoin has been invented by Stan Druckenmiller, when somebody asked him if he would consider shorting Dogecoin, because, he's talking about how it's just a total function of the craziest monetary policy in history, and it's a total, Gradle fool theory. And he goes, having said that, and I'll give you the quote, I wouldn't short it because I don't like putting campfires out with my face. So I pretend Doge doesn't exist. And I love that, Ash, because that's kind of like, what our attitude maybe has been towards the Bitcoin rally. And it's like something we could observe. It's not necessarily that we need to go hurt ourselves and be short, but, we understand what the functionality of it is. So I love that Druckenmiller quote as it related to the Bitcoin crash last month. So as of now, Bitcoin is catching itself in a range between 35 and 40K. But let's go back to the dollar being off 1.5% in May. When I see that, the next thing I look for is, was that a good enough tailwind for the commodity markets that I'm long and strong now? What was the answer? Did commodities rally with that tailwind? 8% rallies in gold and silver, 4% rallies in oil, copper, and aluminum, and 3% rallies in gasoline and the Bloomberg Commodity Index last month. So we did get the tailwind that we were expecting from the weaker dollar. That is just an important box to check, right? If we're following the macro fuel to this rally. If you want to drill down another level into gold and silver rallying 8% apiece, the two leading sectors on the month that I've been following were XME and GDX, so metals and mining on the industrial side, and gold, metals, and miners up 15%. So now it tells me again that we're looking in the right direction for the equity play out to what is going on with this massive monetary policy experiment that we're going through. So it's important for me to get to the end of the month and sort of go through that process, Ash, of seeing, is the trend in the dollar that I'm looking for happening? Yes. Is that causing tailwinds in commodities? Yes. Which commodities are doing the best right now? Oil, gold, and silver. Really important that precious metals have taken the lead this month as the inflation story gets more pervasive. So I'm just kind of following things like that. There are a few other tells that are interesting. Technology on the weak side seems to become, something that shows up for me every month now. We just had the first negative month since September in FANG stocks. Really, really relevant that the whole complex finally took a breath. Nasdaq backs off 1.5% last month. That's the first negative month in the Nasdaq since October 2020. software, internet, cloud storage, social media, all negative on the month. So I kind of look at this, Ash, to wrap up that whole May exercise that we just did. I look at it like tech is definitely sagging with higher yields, and precious metals and natural resources are rallying. So when I identify those themes, it gives me confidence to stay in the trades that I've been in, and more so look for places where I want to be doubling down in those trades. Is kind of my strategy. So everything is kind of panning out, in May, as it sort of has been showing up on our radar screen: strength in natural resources, weakness in the dollar, and we threw a Bitcoin crash right into the middle of it to shake things up. So I think we're coming out of it, starting off June on a positive foot. As you can see, crude oil markets right to a new high to kick the month off. OPEC is going to continue with their gradual supply increase to meet the demand increase, and people are taking that and other things as a sign that the energy markets are heading higher. So to me, Ash, this is the consummation of the inflation trade, hitting the crossroads where the inflation trade intersects with monetary policy, intersects with fiscal policy, intersects with politics, and it's slowly panning out on the screens. Is that fair to say?
Yeah, that's a great summary of all the things that are happening right now, and very well said at that. So let's dive in. Lots of questions. I'm sure lots of questions from the subscribers, from the audience as well. But let's take something to make a terrible pun. You said macro fuel. Let's talk about fuel. Brent right now, 2-year highs, global benchmark price over $70 a barrel. Obviously, this is a considerable run up from where we were at the depths of the pandemic crisis. Talk to us a little bit about what you see, the layer of detail beneath the surface.
Yeah, I think you got to watch the Biden administration closely, Ash. They're making a lot of moves that are directly affecting the energy markets. Closing the XL pipeline, first and foremost, that we saw as soon as he got into office, that got shut down. That immediately started tightening up the gas markets. Then just today, there's a headline that I don't know if it's official yet, if he has done it or if he is talking about it, but there a headline about suspending oil and gas leases in the wildlife refuge. And that too is bullish for the price of energy. So it almost seems to me like the Biden administration is trying to get the price of gasoline higher so it can make a better case for its electronic vehicles. And I don't know that we're going to get there in a particularly smooth path. We just saw the Colonial Pipeline attack 2 weeks ago. We see this attack just today hitting the headlines about the world's largest meat supplier, JBS, attacked by ransomware. White House claiming it's Russia. Sounds like another Clinton manufactured headline to me, but nonetheless, there was some sort of an attack on the world's largest meat supplier. So these are the things that are going to even, tighten the spigots even more on the inflation trade. It manifests itself once again in the Barron's cover this weekend with the everything shortage, if you got to look at that. The supply shortage trade, the inflation trade is now getting to the front pages of the financial periodicals. It's going to become household news before you know it. I just don't know that that is necessarily going to stop the price of gasoline from going directly to $5 a gallon here in the Northeast.
Yeah.
It seemed like last week, just one more point, Ash, that the Journal tried to tip us off on Wednesday, with an article about, $5 gas prices of California going nationwide. And that's going to be something that happens when Biden starts exporting energy policy around the country. And next thing you know, there are all kinds of carbon taxes built into your fossil fuel. So all of these things are really positive energy. That's going, happening right on the screens before us. I think it's probably the most important trade for people to follow right now, and I'm not taking my eye off it.
Yeah. Talking of which, your point about the national parks, it looks like that actually went through by executive order. Biden freezes oil leases in Alaska. This is a headline coming to us from Politico. This is about 2 hours ago. And this, of course, is ANWR, the Alaskan National Wildlife Reserve, obviously a massive space with a tremendous amount of natural resources, but of course, something that's very controversial because of its environmental sensitivity. This is a really interesting point, Tony, and I'm curious. We've talked a little bit about the context. We've given a little bit of the history, a little bit of the background. I'm curious, how are you playing this or thinking about playing it?
Well, I'm usually looking to the credit markets to give me signals, and they're giving me nothing right
Mm.
now. With U.S. 10-year yields are kind of pinned to right around 1.6%, give or take. Break even 5-year and several other market-based inflation expectations have been sort of range bound since we got that big CPI number a couple of weeks ago. They've very much cooled off and been range bound. So I've got an eye on them for the market's next reaction to something headline inflationary, if that's fair to map it out like that, Ash. I'm kind of looking for, today we got some more inflationary headlines within the ISM number. Once again, the ISM number, prices paid, was a huge number, like 88, 89 or something like that. Saying that the services industry are paying up for raw materials. This isn't, postulation at this point. It's evidence based. So these are the things that are, pervasive in the market right now. And I think the most important question that people are asking themselves is, number one, are they hedged for this inflationary environment in the markets? And now, number two, most importantly, are they hedged for what could potentially happen to the price of energy if Biden goes and continues this policy of, squelching fossil fuels and trying to promote wind and solar? So,
Yeah.
we're gonna kind of ride that balance this year, but it doesn't look to me like there's any way out of this other than $80 crude oil and $5 gasoline at the pump, and then we'll see. But it seems like we're on a mission to get to that point right now, come hell or high water, and it's kind of unfortunate, but we're just going to play the cards that we're being dealt.
Yeah. Obviously, the oil prices and gasoline prices don't always move exactly in tandem. There are crack spreads, there's distribution issues, there's a lot of technical stuff behind the scenes. But look, if oil prices are in a secular rising regime, it's highly likely that that's going to feed through to consumers. That's going to come through. You're going to pay it at the pump. And that is something that I know that a lot of Americans are keeping an eye, particularly since we've all been locked in our houses for the last 14 months, and everybody's eager to jump on the road now. The weather is getting nice. This is an interesting story. I'm curious if you think about this when you think about how you put trades on around this. Do you look, for example, at the major oil producers? Do you look at E&P? Do you look at the commodity itself? Not necessarily right now, but how do you think about this more generally when you translate this sort of analytic view onto the trade?
Yeah, Ash, I'm usually allowing the performance to, direct me to the sectors that are running out into the lead. And then I'm kind of pulling back and looking at, the charts for tactical opportunities within those trends, right? There's a lot of names that have been consolidating, and maybe just now there are a few that are breaking through moving averages and heading higher. Some have already broken through moving averages, and now maybe we're getting a chance to pull back to a place where you can put on a good risk reward. And for me, I keep that really simple, like we've discussed. I'm a basic 50, 100, and 200-day moving average guy. I like to use stick figure drawn trend lines to actually follow how trends are going, and I don't mind trading off of those, especially when they intersect with moving averages. So it's kind of the thing, Ash, where you're looking at your pad and you see what's going on the screen and see what's performing, and trying to understand if you are exposed to that enough right now. I feel like given this push, there's just a lot of dynamic heading that's contributing to higher gasoline prices at the pump, and it still feels like something that's sustainable. So you're seeing the refiners start to pick their heads up today. They've rallied with the price of oil, of course, but they've been sideways trying to decide if the post-COVID demand is going to be back. And, now that we're having sort of some supply side issues, we're having political issues, the refiners are just tightening up and going ahead and rallying ahead of some of the E&P companies and some of the oil services companies now. So I think that's interesting that they are, that's sort of a cyclical part of the sector that's rallying. So that's giving me some confidence in the economy and being long some of the other industrial sectors, quite honestly. So, we're kind of always doing an overlay of the fundamental performance with where is that security on the chart, and trying to decide where our opportunities to amp up the risk reward are.
Yeah. We've got some questions here that are coming into us fast and furious, no surprise. Let's go to the first one from Sir. The question is, steel's up, uranium is up, shipping is up, coal is up, copper is up. Can you comment on these sectors as well as gold and silver? So it's steel, uranium, shipping, coal, and copper.
It's the same trade, man. It's the natural resources trade when you're sitting at a hedge fund and your book is full of energy and you think that there might be some alpha somewhere else, you go buy some shipping stocks, right, and throw those on the pile. Or when you're full of, fossil fuel companies and you look around and you say, wow, we don't have any uranium on the books. And uranium is likely to go as well if all the commodities and all the energies and all the base metals are going to start rallying with a much weaker dollar now. So while I do think that's the same trade, I think you have to be a little bit careful diving into any commodity complex without, a full understanding of each specific silo. So I think that they're all, they all behave very differently. At times, they all, however, behave like commodities. And right now, it feels like it's student body up and to the right for everything that's coming out of the ground, likely because the dollar index is, on its lows of the year, which is unchanged on the year, right around 90 in the dollar index. And so I think that if the dollar starts breaking down further and giving a negative reading on the year, you're going to see all of those sectors that you just mentioned continue to go even higher. I think there might, if anything, there's probably a special tightness issue in the steel sector that's very real because of the rising price of iron ore, the rising price of steel alongside it, the rising price of hot rolled coil, the tightness in those markets, the tightness in the curves. That is a market that I'm anxiously pursuing here from my position as editor of the Morning Navigator and trying to get my clients into the right trades. So I do want to touch specifically on the steel sector because I'm in it right now in the form of being long U.S. steel. I think it's a great play to be in for a number of reasons, both on the commodity side and the sort of political infrastructure side. So that's what I'm seeing. I think that answers that question, if that's fair, Ash.
Yeah, absolutely. It's interesting what you were saying about how essentially right now anything that comes out of the ground is catching a bid. One of the interesting things that happen is that when you see things get bid up very quickly, or conversely, when there's a sell-off, there's like this general movement where the tide pushes all boats up or all boats down. And then once that trend starts to get a little bit longer in the tooth, traders step in and they go, well, maybe it's a little bit different with coal versus steel, right? And they start making those distinctions. And that's an interesting sort of thing in terms of the life cycle of how these play out.
That's exactly right. We have seen, I've been on the Goldman Sachs commodities desk where you'll see, people come in buying soft commodities and, in 15 minutes worth of homework and looking at the exchange and looking at the spreads and having two conversations, you learn there's really no tightness at all in the soft market. So are they just buying these to buy commodities? In which case you can get, at least you can develop a two-sided market there where you might be willing to part with your coffee, sugar, cocoa at these prices if there's a fund paying a gigantic spread for them. And then, like you said, the reality sorts itself out, is that's what comes out in the actual data. So that is very important to notice the dynamic and how they move against each other.
Yeah, it's fascinating. You see situations where people go, well, I don't know. This one's moved up 7%, 8% in a month. Can we bid something else here? And then
exactly. It's most importantly, Ash, along that line, and as you just taught everybody, our listeners, a great lesson there. That's on the way in. On the way out, everything is a commodity, right? All of it. It's all the same thing. The shipping company, the uranium company, the steel company, the gold miner, the industrial, it's all the same company. When commodities are going off, it is sell all your commodities, right? And then we'll worry about what happens next, how they sort themselves out. But that's generally how it goes, both on the way in and the way out.
Yeah, when things are dropping, there are no points for style.
Right, that's for sure.
Here's one now for something completely different, totally opposite type of play here. Prius Omega, one of our regular viewers. Tony, what's your personal opinion on the direction of the 10 yield and or the Fed reaction function?
Super difficult question. A very good question to ask because that is at the center of the macro discussion, right? Is the Fed going to allow yields higher to potentially slow down an inflationary economy, to potentially, put a clamp on this massive spigot of liquidity that they've got open. So I have to say, my view is that yields are going to force the Fed's hand at some point. I would imagine that I don't think that they get involved with yield curve control, and this is just pure speculation, which I've been wrong a million times and maybe a fool's errand. But if I had to make a guess, I would say that I don't see that the Fed's stepping in to keep rates low until, say, the 10-year gets to somewhere like 2.5%, 3%, which was, I think the highs recently were around 3.5% when Trump was in office. I got a feeling that the bond market is eventually going to be tested on a number of different inflationary fronts. And I think that's going to force yields from this 1.6 to 2.5 level. And then we'll see when we get towards 3% in the 10-year as we approach that sort of new level of what does this mean for treasuries now? So I want to be a secular treasury bear, to be quite honest with you, but I am 100% aware that the Federal Reserve is not going to let rates spike to the extent that it's, something that seems like it causes a lot of volatility in the bond and equity markets. So I think they're going to want to provide an orderly sell-off if that's what happens. And then we've got to try to figure out the tapering question, which makes it another dimension harder for me. So my view in yields is the yields can go up. I think that somewhere around 3% in the 10-year that we'll start to see the Federal Reserve say, whoa, maybe here's where we start talking about yield curve control. And I'm not quite sure how to price in the tapering, to be quite honest with you. But that's my honest view on that, Ash.
Yeah. And to put in a few data points around that very well-argued analysis, the highs on UST 10s on a yield basis, 3.2-ish around October, November of 18. And one of the things that's really interesting is it rolled down dramatically to 1.5% before the COVID crisis. So pretty significant, 50% drop on a percentage basis in those yields going in to 2020. By the time we hit, it looks like a little above 1.5% before the COVID crisis hit 1.57, 1.58, like that, before the COVID crisis broke.
And what's the low in yield, Ash, in the 10-year since COVID?
Looks like it's about 50 bips, 50. Yeah, 52.
Gotcha. Yeah,
I'm eyeballing this, but it looks like about 52.
No, good enough. It's just good enough to have that boundary in your memory at some point.
Yeah. So I mean, those are huge swings, right?
Yeah.
I think because it's so compressed, it's so flat, we forget percentage basis, massive changes.
Yeah.
A lot of
it's going to continue, and it's going to continue.
All right. While these questions are great, I'm going to keep hitting them. This one comes to us from UIM. What do you have? Do you have any comments on 5G stocks? Any good players to keep an eye on?
I am not the guy to ask, and I wouldn't even want to push you in the wrong direction. So I always answer questions that I don't know the answer to, honestly, with I do not know. I'm not a long technology player at the moment, and I'm sure there are some gems in the 5G space. I just don't know what they are.
One of the best and smartest answers anyone can give.
I can't hurt myself with that, can I?
Indeed. This one comes to us from Brett Calder, wants to know about the Triple Q and XLF, of course, it's Nasdaq, and the Select Sector Spider for financials.
I'm bullish financials and I'm bearish Triple Qs, if that's fair in a nutshell. I'm seeing things in financials. Financials are, the leaders and the laggers have become very clear all of a sudden. Goldman Sachs and Morgan Stanley just observationally have got up and taken off, in percentage terms from the ranges that they were in while we had yields pinned around 50 basis points in the 10-year, right? Behind them have been, the big money center banks with JP Morgan, Bank of America, Citigroup just exploding. And then behind them, you've always got the laggards of the international banks and some of the smaller regional banks. But I'm bullish financials, I think, coming out of this, flat, to no yield period into an inflationary environment with the yield curve widening out. I just think over time, the financials are going to be an easy long, to be quite honest with you. So I can speak directly to that. And what was the other side? Triple Qs, Ash?
Triple Q.
Yeah, I think it's fair to observe just that tech has been struggling since yields popped. That since 10-year yields made that 1% move. Call it even more so since the that 5 sigma daisy cutter, that huge sell-off we had in the bond market that spiked yields up. It was, I believe, it was in February 25th, that spiked yields up to like 165 the first time. So for me, that has been the moment that the portfolios began to shift dramatically, and it looks to me, just judging by weekly and monthly performance, that the laggers have been technology, and the performers have been the natural resources space. So within technology, I'm still riding, for example, a solar stock short that I've had on since January of this year. I still think there are a couple of sectors that can continue to back off, and I don't want to be long technology in a rising yield environment because they performed so well in a no yield environment. So I want to be really
Right.
careful about being long tech.
Yeah, explain a little bit about why that is, Tony, about the discount factor and why these high growth stocks tend to, really excel during periods of low rates, but back off during periods of rising rates.
So you nailed it right there, Ash, is that, the investor goes after the growth stock when there is a period of abundant liquidity, right? Like we just came, we've been going through this phase of, pretty unlimited Fed liquidity for years now. Technology, the growth companies, innovation has been really, really highly valued during that period. A lot of, the FANG complex has gotten, was off and running, and then it suddenly leveled off and is still, you could argue, in a very, very slightly improving incline, if I may use that word. But broadly speaking, it feels like the tech sectors where every single month it was software, internet, social media, semis up 5%, right? That is over. In fact, in May, I think pretty much all of those sectors finished in the red in a month when the S&P was flat and natural resources rallied. So as you can see within the rotation, there is definitely becoming a clearer favoring of, industrial, cyclical, and sort of value stocks even, versus that growth innovation type of stock that gets all the attention when there's abundant liquidity in the markets.
Yeah.
Does that explain it, Ash?
Yeah, and very well said as well. The questions just keep streaming in, so I'm just going to keep going. This is a really terrific question, actually, from Anthony Chias, and I hope I'm saying that right. First, he starts out by saying, Tony, fantastic overview. And then he has two questions that are related. I think these are great questions on the natural resources trade. What is your assessment as to how crowded these trades are, if at all, number one? And number two, what is the most common bearish counter argument you are hearing? Great questions.
Fantastic questions. Let's go with the counter bearish argument first, and then you're going to remind me of the first question because I had an answer to that as well. The argument to the inflation trade is that technology continues to be deflationary, number one, and that all of this debt that we're taking out continues to be a deflationary force, number two. So those are the sort of counter arguments to lasting inflation. There are people that are looking at, portfolio managers that are looking at this from a very calm perspective and saying, okay, I can point to a couple of supply shortages here and here. And if those are solved, the price incline will be transitory, like the Federal Reserve is telling me it should be. And they're playing off of that, quite honestly, because if the Federal Reserve is guiding portfolio managers towards transitory, that's what portfolio managers are likely to listen to. So that, I think, answers the second part of the question. What was the first part of the question again, Ash? Because it was very good.
Yeah, what's your assessment as to how crowded these trades are, if at all?
Yeah, well, put it this way. My note in my morning navigator this morning was very much about, I hope everybody sees the Barron's cover, the shortage in everything, because now the trade that we've been in for a year is front page news, right? So I am very much acknowledging now, not the positioning has not been outrageous in really any of the commodities yet, as far as I'm concerned. I've seen much more imposing long positions going into commodity rallies, and I've seen them sustain for much longer periods of time than we've currently been running. So I do think that it's starting to get become a participated in event. I don't think we're at the level yet, though, where real money portfolio managers have adjusted their Queen Mary boats and started pointing them toward a more natural resource-based inflationary environment versus the one that they've been living in for the last 10 years, right? So I still think in this 1 year, call it, since we had this exogenous shock, I still think 1 year later that portfolio managers are still figuring out exactly how they want to play it and are still moving their money in that way. So I do think it's getting a little bit more crowded. It's something that's getting higher on people's radar screens, but because it's attached to a fundamentally strong commodity trade, and as long as those commodity spreads on the exchange stay firm and backwardated, I can expect these rallies to continue longer than bears can stay solvent, if that's fair.
Longer than bears can stay solvent.
Right?
Yeah.
Those are the people that are going to be selling us the oil contracts up here at $68 because they think that it's going to be, this is just a flash in the pan. Whatever it is, the economy is going to soften up, oil is going to fall back. That's fine. They still have to find somebody to sell them the oil at a lower price, and I ain't seeing that happening at all.
Yeah. Extremely well said. By the way, I don't know if you saw this, Tony, but apparently the Queen Mary is sinking.
Oh, Jesus.
Throw
that on the pile.
Well, apparently there's some structural problems with the boat itself, with the ship, I should say, and there's a risk of it sinking in the next 3 years or something. And they gotta raise $25 million to do these structural repairs. While you were talking, I just jumped in to a long-term chart of oil. I was thinking about my days working at BB&T and being on the trading floor and watching oil hit $100 a barrel rather, excuse me, in 2007, and the trauma that brought, and also the euphoria for those who were long. Hadn't hit that price level going back, it was 28 years, 1980, the 1970s oil crisis, the embargo, all of these things. So this is really a wild market. It's an interesting chart just to look at this going back, even in nominal dollars. We've got data on this, really good data going back to the 40s, I think, on WTI, and it really is an interesting market to observe.
Absolutely wild. It's really in play right now. I mean, there is an administration that is clearly walking in the door and blowing the doors off of the old administration's energy policy, right? They're literally blowing it up, destroying it, and sending it down the river. They're employing their own energy policy. It is getting more and more expensive for you and I by the day. And at some point, this will come to a head where it won't be politically feasible anymore to go ahead and shut down, drilling permits just because they're in wildlife refuges, just because they're in another place that we've been drilling for 10 or 20 or 30 years. And hopefully we'll get back to supplying the nation with the energy that it so desperately needs every day, rather than this wind and solar idea.
Yeah. Here's one that comes to us from Tom, also another Real Vision Daily Briefing regular viewer. The question is, what do you think the VIX levels are signaling? For those who aren't watching, VIX right now trading around 17.9.
I still think VIX in the teens is too cheap. I really do. There was a nice rejection of VIX in the teens last time. I believe that it was either the CPI number or the Bitcoin crash that caused a bit of volatility that popped it back up into the 20s. Volatility is probably sagging again as stocks head into new highs, but that is a signal to me. I mean, you can let the VIX sit down here in the teens and watch it, but I wouldn't let it sit down here for too long without buying something. It always seems like this is a nonlinear market, that the bull market gets excessively long at the peaks, and then we have pullbacks or an exogenous shock or whatever it is. So to me, I don't really trade the VIX that often, but what I do look at is when it gets depressed, I do look at buying some protection on my S&P position, because it makes sense to me that volatility is way too cheap in the teens, given the global macro situation that we're in right now. I mean, there are still tectonic plates shifting really, really sharply underneath the surface between the U.S. and Russia and Europe and China, and I would not want to be short any commodities in this scenario.
Yeah. Here's a fun one that comes to us from Weston. I believe this is our own Weston Nakamura, or someone who's doing a very good job
My
impersonating.
man.
Weston's awesome. I just actually did a couple of Real Vision pieces on the exchange with Weston. They're really really interesting, I think. One about Bitcoin and another about some of the ESG things that we've been talking about and how it's going to influence markets. So Weston, obviously one of the really terrific people here at Real Vision. Always enjoy getting on camera with him. And the question is, Tony, I'm in your seat tomorrow on RVDB Live. Any thoughts on China's attempts to clamp down on metal futures speculation and or PBOC and yuan strength non-response?
My thoughts on the China attempt to squelch the commodity rally are that they are adorable. I think that it's absolutely precious that China is going to try to clamp down on speculation and this and that. They may be able to make a few things illegal in their center of the world. Broadly speaking, I do not think that they are going to be able to stop the tsunami of investment that is coming in the commodity space. I don't think they're going to be able to stop the tsunami of a bid behind the green energy movement here in Europe and in Asia, quite honestly, where we're going to need. I was just reading an article that I'm going to put in my note for tomorrow. It's just, we are going to need, to break it down, 5 and 6 times our annual production of lithium and cobalt to try to get this green trade on the tape, to build batteries and to build all kinds of electronic vehicles and things like that. So I think it's just going to be too massive of a strain on metal resources, so I can stay in this metal trade. And I think I got away from the question there a little bit, but I don't think that China is eventually, big picture wise, they may cause a blip. Yeah, but that's how I'm literally playing it. I don't think that over time that they can cause the prices of commodities that there's a line out the door for right now, right, to turn around and start heading south with any kind of degree of sustainability. That's what that's, forget about that scenario. So, it's a headline. That's all it is. It's a headline. Trade around it.
Yeah, I think you answered the spirit of that question perfectly, which is, are the attempts going to be successful? And the answer is that you provide is probably not.
It doesn't feel like there will be. No, not at all. And even traditionally, attempts in the U.S. to sort of, stomp out speculation haven't worked. They raise margins on the exchange. The commodity sells off 10% over 3 days, and the rally gets right back on its feet again. So I would expect a lot of the same here.
Yeah, very well said. And thanks for the question, Weston. By the way, I think it's like 5 in the morning or 4:45 where Weston is right now in Tokyo.
He is a diligent bastard, isn't he?
He's a machine. That's what he is. He's a machine.
I love it.
This is actually a really insightful question from Eric Frith. And the question is, does the natural resources trade still work without runaway inflation? It seems, he says, like they're just underinvested, undervalued, regardless of whether rates are at 2% or 5%. Really interesting observation. Tony, what are your thoughts?
Man, that question makes me bullish. Right? It's like, the question is that what's the essence of the question?
The essence of the question is basically, look, even without the sustained rising prices, this stuff looks underinvested. It looks cheap.
Would they be rallying if we did not have an inflation story? That is a good question, right? Because, before COVID, call it, BCOM was in a secular decline. It was consolidating, going sideways to nowhere. You could make the case that if it were just this green movement that were being implicated on, in the U.S. and in Europe and a little bit in Asia, that there would be a natural draw on these commodities anyway. Right. And now we're in a situation where, the biggest economy in the G10 is expanding its debt pile, expanding its balance sheet, trashing its currency, spiking inflation without question in the energy patch. So it's a good question because I think the answer might be yes. Right. And that's what kind of makes me incrementally more bullish, is that even if we didn't have, we didn't get that headline inflation data, piece of data 2 weeks ago, the markets feel like they would be in this mode anyway. So I think that's a good observation. And it just ties in, even more so to the fact that, playing these commodities from the short side now, may look like an intelligent idea for you, but I don't know what is going to make the price of that commodity go crashing down when there's a line out the door to buy it. And that's just how I'm seeing it right now.
Yeah, it's a great question. Obviously, it's a counterfactual. You can't answer it definitively, but it's a
Right.
great thought experiment to think through because it does make you wonder. Look, if there's this like this secular tailwind on this, despite the inflation story, isn't that precisely as you said, an even more bullish indicator?
That's right, and also, similarly in our trade, if headline inflation really calms down again, do we have the confidence to stay in the commodity trade because of its own merit? And I think the answer is that I probably would. I mean, I would probably trade around it like a wild beast, knowing that there would be some kind of weakness that I'd be facing. But I think that I would be looking to get back into a secular uptrend in commodities off of that treacherous BCom bottom we saw last year, about a year ago today.
Yeah. Here's a quick question for CG. CG wants to know where the file cabinet is. CG, it is somewhere hidden back there. I'm trying to class the place up a little bit. I want to compete with Tony's elegant set.
Yours looks great. It looks beautiful, Ash.
So, Tony, we've gone through a lot of questions here, a lot of really, I think, great, insightful questions.
Yeah.
And I'm curious, where do you land on some of this? How are you thinking about the future? And what are you going to be looking at between now and your next Real Vision daily briefing appearance?
Well, June's a big month. June defines the halfway point in the year, so I like to, make very careful observations at the end of the half year, because a lot of times the second half of the year is just a continuation in certain magnitude, right? It's kind of picking, the first half of the year has given us the chance to see, okay, metals and mining, energy, natural resources, home builders, infrastructure, all of that stuff is going to outperform tech this year, right? It's just a question of how much. So I feel like, heading into the end of the year, I'm anxious to see where the final June performance shakes out, how that first half of the year shakes out, and then sort of try to place my chips on the table for the rest of the year. It looked like to me, for example, like energy, metals and mining was going to stay in the lead, and now it looks like energy is just going to run all over it again. So, it's kind of jockeying back and forth between the winners and trying to make sure that you're exposed in the right way. And, it's kind of just going through and checking the boxes every month. Are we staying in that downtrend in the dollar? Do we have the tailwinds from the market-based inflation expectations? And the beauty is that if any of that changes, we'll know it, and we'll get a chance, hopefully, to adjust our positions accordingly. But I'm kind of looking for places right now to double down on these bets for the end of the year, to be quite honest with you.
Yeah, talking about the second half of the year, let me just throw one more out there for you. The old chestnut, sell in May and go away. Obviously, historical underperformance during the summer months, lighter volume. What are your thoughts? How does that shake out this year? Is it material at all? It's just a thing that people say, especially when we have this, this people potentially going away because they've been, trapped in their apartments and their houses.
I would not be lulled to sleep into thinking that 2021 summer is going to be any kind of quiet in the commodity space. I mean, I'm prepared to work every single day through this and see what opportunities present themselves, because this is like the World Series coming to your backyard, and you don't want to fall asleep on the trade that is well in motion, because we're heading into summer and some people don't feel like working, blah, 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 blah. That's nice. The world is changing at a rapid pace outside your window and on the screens. Yeah. And this summer, especially, I think that everybody should be paying attention. And the thing about volume, I have a serious view about volume, Ash. Like I used to always lean on volume as an equity trader, and I learned, and a commodity trader, and I learned that since we've transferred to largely 100% electronic trading, and there's no more block trading anymore, and there's no more, 6 portfolio managers convening at a price and changing hands of ownership of a company, that volume doesn't really matter as much to me anymore. I've kind of thrown like needing a high volume day to support my thesis out the window, because, every portfolio manager out there now executes over the course of the day. Not one portfolio manager out there has a price limit on what he's buying. Nobody has a limit on what they're selling. They just put orders in the wood chipper, and at 4 o'clock they get their report. And so as long as traders are still thinking about the world that way, I'm not going to put a lot of weight in letting volume affect my decisions.
Yeah, my very simplistic analysis would be I wouldn't bet on anything in 2021 looking like anything in the past, particularly these sort of quaint old chestnuts that get rolled out from time to time. But Tony, I do have to say this. You do have an unfair edge in one way during the summer months, which is you can basically like walk to the beach.
That's true. That's true, and that is a positioning issue that I've worked myself into over the years, and one that I'll keep myself in for a long time to come. Ocean is always close by. Yeah.
Yeah, very well played. Tony Greer, always a pleasure. Thanks so much for joining us.
Great to be here, man. Thanks for great questions, and we'll see you guys in a couple of weeks. See how this shakes out.
Yeah, thanks for watching, everyone. Especially great questions today. Thanks for your participation.
Really well done. Good job, guys. We'll see you next week, Slash.